There's a pattern in history that has destroyed the monetary systems of 27 countries over the past century. And right now, in 2025, the United States is showing the exact same early stage markers that appeared 2 to 3 years before citizens started trading gold for food in Venezuela, Argentina, and Zimbabwe. Stage by stage, mechanism by mechanism, like we're following a script written in the mathematics of monetary collapse. In June 2018, a woman in Caracas traded her wedding ring for 2.5 kilograms of cornmeal. The vendor weighed it on a digital scale, 3.2 grams of 18-karat gold. He didn't check the believer price. There was no believer price anymore that mattered. Venezuela had just completed all 4 stages of monetary system failure in 6 years. In 1989, Argentina watched inflation hit 3,079% in a single year. Gold dealers in Buenos Aires documented a 400% increase in jewelry sales as citizens fled their own currency. Within 18 months, the Austral was worthless. In 2008, Zimbabwe's inflation reached 89.7 sextillion%. That's 21 zeros. Street markets in Harare stopped accepting Zimbabwe dollars entirely. Gold and South African rand became the only accepted payment. The government's currency ceased to function in 30 months. 3 countries, 3 decades, 3 complete monetary collapses, all following an identical 4-stage sequence. And here's what should concern you. The United States money supply grew by 40.4% from February 2020 to February 2022, while the economy grew just 3.2%. That's an expansion ratio of 12.6 times GDP growth. Venezuela's ratio before their collapse was 8.4 times. Argentina's was 11.2 times. American Eagle silver coin sales increased 67% from 2019 to 2023. These aren't curiosities. They're stage 1 markers. Every population that entered stage 3 believed their country was different. They believed their economy was too advanced, their government too sophisticated, their currency too established. The pattern didn't care what they believed. It cared about one thing: the mathematical relationship between money supply and productive capacity. And once that relationship breaks past a certain threshold, the sequence becomes nearly automatic. The experts will tell you it can't happen here, that America's reserve currency status makes us immune, that comparing us to Venezuela or Zimbabwe is absurd, that the mechanisms are completely different. And they're partially right. The US does have structural advantages those countries lacked. But in February 2014, Venezuela's central bank president had to charter 50 new aircraft to fly physical currency from foreign printers because domestic printing couldn't keep pace with monetary expansion. It was a logistics problem, he said, just a temporary liquidity issue. 38 months later, citizens were trading gold jewelry for food in the streets. The comfortable lie is that it can't happen to advanced economies with strong institutions. But the dollar's share of global reserves has dropped from 72% in 2000 to 58% today, and it's accelerating. 4 percentage points lost in just the past 3 years alone. That reserve currency protection you keep hearing about, it's measurably eroding while the same money printing mechanisms that destroyed 27 other currencies are running at full speed. This is the story of how monetary systems die, why the early stages look like normal policy responses, and what the pattern says happens next when stage 1 markers appear, but everyone insists it's different this time. Let me show you exactly how this pattern works, because understanding the framework is the difference between recognizing the early stages and waking up inside stage 3 wondering how it happened so fast. The sequence has 4 distinct stages, and the critical thing to understand is that stage 1 looks like normal life. It looks like policy response to crisis. It looks like government doing what governments do. That's why populations miss it every single time. Stage 1 is currency instability, and it runs roughly 2 years. Inflation rises to 20 to 50% annually. Citizens begin hoarding hard assets, not because they're panicking, but because they're making rational calculations about preserving purchasing power. The government blames speculators and hoarders for the price increases. This is the diagnostic moment. When authorities attribute inflation to behavior rather than money supply, you're watching stage 1 in real time. Venezuela entered this stage in 2012. Argentina in 1987, Zimbabwe in 2006. The pattern doesn't announce itself. It emerges gradually from what looks like manageable inflation. Stage 2 is trust collapse, years 3 and 4. Inflation exceeds 100% monthly. Savings accounts become worthless, not figuratively, but in actual purchasing power terms. A family's nest egg that could buy a car in January can't buy groceries by December. Merchants begin refusing the national currency for large transactions. They'll accept it for small purchases because they can spend it immediately, but anything substantial requires dollars or hard assets. This is when the two-tier pricing system emerges informally. One price if you pay in the official currency, another price, usually 30 to 50% lower, if you pay in dollars or gold. Stage 3 is barter emergence, years 4 and 5. Precious metals become the preferred medium of exchange for significant transactions. Informal exchange networks form organically, not through government planning, but through citizens recognizing they need alternatives to worthless paper. You get dual pricing everywhere: official currency prices that are meaningless and hard asset prices that reflect actual value. Venezuela hit this stage in 2017. The gold district in Caracas had 43 shops converting jewelry to food vouchers. Rural markets used gold dust from informal mining as primary currency. Stage 4 is monetary system failure, year 5 onward. The national currency is abandoned for daily transactions. Gold, silver, and foreign currency dominate all commerce. The government has lost monetary control entirely, not through revolution or regime change, but through citizens simply refusing to use the currency anymore. Venezuela reached this point in 2018 when 54% of transactions in Caracas were conducted in dollars or hard assets. The believers still existed officially. It just didn't function economically. 27 documented cases since 1920. Average progression time, 4.8 years from stage 1 to stage 4. Pattern consistency rate, 96%. 26 of 27 cases followed this exact sequence. The pattern doesn't care about your economic system, your natural resources, or your government's intentions. It cares about one thing: the relationship between money supply and productive capacity. And once that relationship breaks, the sequence is nearly automatic. Venezuela's timeline from 2012 to 2018 is the clearest documentation we have of how the 4 stages progress in a modern economy. December 2012, inflation hits 20.1% annually. That's stage 1, elevated but not catastrophic. President Chavez's government responds with price controls on 165 basic goods in November 2013. This is the mechanism that accelerates everything. Price controls create shortages. Shortages create black markets. Black markets reveal the real exchange rate. By January 2014, the official rate is fixed at 6.3 bolivars per dollar, while the black market hits 47 bolivars. That gap, that 7-to-1 difference between official and real rates, is the measure of the government's lost credibility. GDP growth drops from positive 5.6% in 2012 to negative 3.9% in 2014. The economy is contracting while the currency is inflating. That's the stage 1 signature. Here's the moment that reveals how fast stage 2 arrives. February 2014. Nelson Morentes, the central bank president, orders 50 new planes to fly cash currency notes from abroad because domestic printing can't keep pace with monetary expansion. Think about what that means. The bottleneck isn't policy or economics, it's the physical logistics of printing enough paper money fast enough. That's not a currency anymore. That's a printing exercise. January 2015. Inflation reaches 68.5% annually. December 2015. 180.9%. The money supply grows 87% in the single year of 2015. December 2016. The IMF estimates 254% inflation. And here's the number that shows what's happening to ordinary people. Minimum wage could purchase 54 kilograms of food in 2012. By 2016, it purchases 3.5 kilograms. A 93% collapse in purchasing power in 4 years. The mechanism is brutally simple. Government prints currency to cover budget deficits. Fiscal deficit reaches 20% of GDP in 2016. Each new believer printed dilutes all existing believers. Citizens rush to convert currency to goods immediately because holding it overnight means losing value. Velocity of money accelerates. Inflation feeds on itself. And here's the pivot point that marks the transition to stage 3. March 2016. First documented cases of Venezuelan citizens trading gold jewelry at merchants for food, not at pawn shops, at grocery vendors. Gold jewelry shops begin posting daily exchange rates, gold grams to food items. No believer price listed. That's the market telling you the official currency is finished as a unit of account. By 2017, Caracas merchants accept payment in this hierarchy. First US dollars, second gold, third Colombian pesos, fourth bolívares, but only with a 30% premium to cover the depreciation risk between when they receive payment and when they can spend it. Venezuela wasn't unique. The same sequence played out in Argentina and Zimbabwe with remarkable consistency, only the velocity changed. Argentina's first wave hit in 1989, March of that year, monthly inflation 95.5%. July, 196.6%. Annual inflation for 1989 reached 3,079%. Buenos Aires gold dealers documented a 400% increase in jewelry sales between May and August as citizens fled the Austral. The government replaced the currency in 1992. 10,000 Australians became 1 peso. That's not reform. That's admission of total failure. The driver was identical to Venezuela: government monetizing debt. Argentina's fiscal deficit in 1989 was 7.6% of GDP, with the central bank financing 81% of deficit spending. Print money to cover the gap, currency dilution, inflation acceleration, trust collapse, the exact same mechanism. And here's what should get your attention. Argentina is running the pattern again right now. December 2022, annual inflation 94.8%. December 2023, 211.4%. The blue dollar black market rate hit 1,015 pesos per dollar in December 2023, while the official rate was 366 pesos. That's a 277% gap between official and reality. Buenos Aires gold merchants reported a 340% increase in transactions from January to December 2023. Stage 3 indicators are visible: dual pricing systems, dollar preference, increased precious metal trading. A 2023 survey found 73% of Argentines hold savings in dollars or hard assets, not pesos. That's trust collapse documented in real time. Argentina is currently at stage 3. The barter networks haven't fully formed yet, but the mechanisms are active and accelerating. Zimbabwe set the speed record. January 2007, annual inflation 1,281%. January 2008, 100,000%. Mid-July 2008, 231 million%. Mid-November 2008, peak inflation 89.7 sextillion%. That's 21 zeros. The progression from stage 2 to stage 4 took just 18 months. By July 2008, gold jewelry was accepted at 78% of merchants in Harare street markets. South African rand became the de facto currency in border regions. Grain merchants demanded gold or foreign currency exclusively. The government was still issuing Zimbabwe dollars. They printed $100 trillion notes, but nobody was using them for actual commerce. The currency existed officially while functioning 0% economically. Zimbabwe's central bank governor, Gideon Gono, authorized monetary expansion exceeding 200% monthly by mid-2008. The pattern is consistent, only the velocity changes based on how aggressively you violate the fundamentals. Venezuela took 6 years, stage 1 to 4. Argentina's first wave took 4 years. Zimbabwe took 2.5 years. 3 countries, 3 different decades, 3 different political systems. The same 4-stage sequence, the same outcome. The United States isn't Venezuela. It isn't Argentina. It isn't Zimbabwe. But patterns don't require identical conditions. They require identical mechanisms. and 3 specific mechanisms from the historical sequence are now documentably present in America. Here's the data you need to see. Mechanism 1. Monetary expansion rate. Every hyperinflation in the historical record began with money supply growth exceeding GDP growth by a factor of 3 times or more for a sustained period. US M2 money supply in February 2020 was $15.47 trillion. By February 2022, it reached $21.72 trillion. That's a 40.4% increase over 24 months. GDP growth for the same period, 3.2%. The expansion ratio is 12.6 times GDP growth rate. Venezuela's ratio from 2012 to 2014, before Stage 3 barter emerged, was 8.4 times. Argentina's ratio from 1987 to 89 was 11.2 times. The United States just ran a higher expansion ratio than the 2 clearest historical precedents. Money supply expansion significantly outpacing productive capacity. That's the Stage 1 indicator that appeared 2 to 3 years before Stage 3 in every historical case. Mechanism 2. Trust divergence indicators. Citizens begin preferring hard assets 18 to 36 months before barter networks form. This shows up in precious metal purchases, foreign currency holdings, real estate as inflation hedge. American Eagle silver coin sales in 2019, 14.86 million ounces. 2023, 24.81 million ounces. That's a 67% increase over 4 years. Gold Eagle sales went from 152,000 ounces in 2019 to 245,500 in 2023, a 61.5% increase. Google search trends for how to buy silver are up 340% from 2020 to 2024. The Reddit community for silver buyers grew from 89,000 members in 2020 to 267,000 in 2024, a 200% increase. Venezuela saw a 180% increase in gold jewelry sales from 2014 to 2015, 28 months before Stage 3 fully manifested. The U.S. is seeing 60+% increases in bullion purchases over 4 years. The pattern is present, but at slower velocity. Mechanism 3. Fiscal deficit monetization. When the central bank purchases government debt with newly created money, it's functionally identical to printing currency to cover spending. Federal deficit in 2020, $3.13 trillion. 2021, $2.77 trillion. The Federal Reserve balance sheet in March 2020 was $4.24 trillion. By April 2022, it peaked at $8.97 trillion. The Fed purchased $4.73 trillion in Treasury and mortgage securities from 2020 to 2022. That means roughly 65% of the deficit was financed by the Fed during 2020 to 2021. Venezuela did this from 2013 to 2015. Argentina did this from 1987 to 89. The United States has one critical advantage that Venezuela, Argentina, and Zimbabwe all lacked: global reserve currency status. Dollar demand from international trade means monetary expansion can be absorbed globally, not just domestically. This significantly slows the pattern. It's why the velocity is different. But here's what the data shows about that protection. The dollar's share of global reserves in 2000 was 72%. Balai Manu, 2024, it's 58%. That's a 14 percentage point decline over 24 years, and it's accelerating, 4 percentage points lost in just the past 3 years alone. Reserve currency advantage is diminishing measurably, while deficit monetization continues at scale. No nation holding global reserve currency status has experienced hyperinflation while maintaining that status. That's the historical record across 5 reserve currencies, including the British pound transition. But reserve status has always been lost before hyperinflation, not during. The pattern suggests reserve status is protective until it isn't. If the historical progression holds, Stage 1 indicators appeared in the U.S. from 2020 to 2022. The average timeline from Stage 1 to Stage 3 is 3 to 5 years. That puts the pattern-based window for Stage 3 between 2023 and 2027. But velocity varies based on starting debt level, U.S. debt to GDP is 123%, the reserve currency buffer that's currently eroding 1 to 2% annually, and political will to implement austerity, which is currently absent from both major parties. Here's what matters from the historical cases. Early action makes the difference between preserving wealth and losing everything. Venezuelan families who converted 50% or more of their savings to gold or dollars by 2015 retained 60 to 70% of purchasing power. Families who remained in bolívares until 2017 lost 98.6%. The time advantage was 24 months of early action equals 60% wealth preservation difference. In Argentina's 1989 crisis, informal trading clubs emerged 8 months before peak inflation. Members traded skills, goods, and precious metals within trusted networks. External trading carried a 30% premium. Internal trading within the network stayed near fair value. Divisibility became critical. Silver's advantage over gold was smaller denominations for daily transactions. Venezuelan markets used gold for major purchases like rent and vehicles, silver for food and utilities. 1-ounce silver rounds became the standard unit of account in informal markets. The United States possesses structural advantages that slow pattern velocity: deep capital markets allowing alternative financing, rule of law protecting property rights, a productive economy with technological innovation, and diminishing but still significant reserve currency status. But it also has vulnerabilities the historical cases lacked: unprecedented debt levels, federal debt $34.8 trillion as of December 2024, a complex financial system creating fragility, and political gridlock preventing structural reforms. Pattern recognition isn't prediction, it's preparation. The 4-stage sequence has played out 27 times with 96% consistency. The early stage mechanisms are documentably present. Reserve currency status has historically prevented progression, but that status is measurably eroding while the money supply mechanisms run at full capacity.